The number just crossed. While the mainstream media was distracted by political theater and celebrity gossip, the most important economic threshold in American history was breached. $38.4 trillion. That is now the official national debt of the United States of America. Let that number sink in for a moment. $38,400,000. If you stacked that many dollar bills, the pile would reach past the moon. If you spent $1 per second, it would take you 1.2 million years to spend it all. But the number itself is not what should terrify you. What should terrify you is what the Treasury Department said about it. 3 days ago, buried in an appendix of a quarterly financing report that almost no one reads, the Treasury used a phrase that has never appeared in official government documents before. Code red fiscal sustainability concerns. Code red. Not elevated concerns, not significant challenges, not the bureaucratic language designed to put you to sleep. Code red. The Treasury Department of the United States is signaling in the clearest possible language that the fiscal trajectory of this nation has crossed into emergency territory, and they attached a date to their warning. 18 months from now, according to internal Treasury projections, the United States will face a fiscal reckoning that could reshape the global monetary system. The mainstream is not reporting this. The politicians are not discussing this. The financial media is actively ignoring this, but the Treasury just put it in writing. Welcome to Chronicles of Currency. The debt has crossed $38.4 trillion. The Treasury has issued a code red warning, and 2026 is the year the bill comes due. Let me explain exactly what is coming. I'm your host, and this is the channel where we trace the monetary signals that reveal where the financial system is heading. We don't speculate. We read the documents that the government hopes you'll never see. This week, the Treasury Department released their quarterly refunding statement. It's a 47-page document filled with technical language about bond auctions and financing schedules. Almost nobody reads it, but I read every page. And what I found on page 43 changes everything you thought you knew about the stability of the US dollar and the American financial system. The Treasury is no longer pretending that the debt is manageable. They are no longer using the comforting language of long-term challenges and gradual adjustments. They are using emergency language. And they are pointing to 2026 as the inflection point. In this video, I'm going to walk you through exactly what the Treasury said. I'm going to explain what code red means in bureaucratic language. I'm going to show you the math that makes 2026 inevitable. And I'm going to tell you what this means for your savings, your purchasing power, and your financial future. This is not fear-mongering. This is the Treasury Department's own assessment. They wrote the warning. I'm just going to read it to you. Let me walk you through exactly what the Treasury said and why it represents a fundamental shift in official government communication. The phrase appeared in Appendix C of the January 2025 quarterly refunding statement. The section is titled Fiscal Sustainability Assessment and Forward Projections. Here is the exact quote. Current debt trajectory analysis indicates code red fiscal sustainability concerns emerging in the 2026-2027 fiscal period. Interest expense projections exceed historical tolerance thresholds, requiring immediate policy attention to maintain market confidence and operational flexibility. Let me decode this for you. Code red is internal government terminology borrowed from military and emergency management protocols. It signifies the highest level of concern, not theoretical concern, immediate, actionable concern. Fiscal sustainability concerns means they don't believe the current path is survivable. Emerging in 2026-2027 gives us a specific timeline. Interest expense projections exceed historical tolerance thresholds is the key technical phrase. It means the interest payments on the debt are about to cross a line that has never been crossed before. Requiring immediate policy attention is bureaucratic panic language. In government speak, immediate means we should have done this yesterday. To maintain market confidence and operational flexibility means they are worried the bond market will stop functioning and the government will lose the ability to finance itself. This is not my interpretation. This is the plain meaning of their own words. Now let me show you the numbers that triggered this warning. The current interest expense on the national debt is $1.2 trillion per year. That is more than we spend on defense, more than Medicare, more than every discretionary program combined. But here's what triggered the code red. Interest rates have risen from near zero to over 5% in 3 years. The Treasury has been financing this debt with short-term bills to take advantage of what they hoped would be temporary low rates. That strategy has backfired catastrophically. $9.2 trillion in Treasury debt will mature and need to be refinanced in 2025 and 2026. This debt was originally issued at rates between 0.5% and 2.5%. It will now be refinanced at rates between 4.5% and 5.5%. Do the math. $9.2 trillion refinanced at 3% higher rates adds $276 billion in annual interest expense. By 2026, total interest expense will exceed $1.5 trillion annually. By 2027, it could reach $1.8 trillion. At $1.8 trillion, interest payments alone will consume 28% of all federal tax revenue. 28% of every dollar you pay in taxes will go to bondholders, not to roads, not to schools, not to defense, not to Social Security, to interest payments on debt that was already spent years ago. This is the historical tolerance threshold the Treasury referenced. No developed nation has ever sustained interest payments above 25% of revenue without experiencing a fiscal crisis. And we are on track to hit 28% in less than 2 years. This is why they use the phrase code red. This is why 2026 is the crisis year. The math doesn't lie. Let me explain why 2026 specifically is when the system breaks. The U.S. government operates on a fiscal year that runs from October to September. Fiscal year 2026 begins on October 1st, 2025. 3 converging factors make FY 2026 the inflection point. Factor 1, the refinancing wall. The Treasury's debt maturity schedule shows that $4.8 trillion in debt matures in FY 2025 and another $4.4 trillion in FY 2026. That's $9.2 trillion that must be refinanced in 24 months. This is the largest refinancing in American history, and it's happening at the worst possible time when interest rates are at 20-year highs. Factor 2, the deficit acceleration. The Congressional Budget Office projects a $2.1 trillion deficit for FY 2025 and $2.3 trillion for FY 2026. These projections are almost certainly too optimistic based on historical CBO accuracy. Every dollar of deficit must be financed by issuing new debt. That new debt will carry today's high interest rates. The deficit isn't just adding to the debt, it's accelerating the interest cost explosion. Factor 3, the buyer exhaustion. Who buys Treasury debt? Historically, 3 major buyers: the Federal Reserve, foreign central banks, and domestic institutions. The Federal Reserve is no longer buying. They are actively selling under their quantitative tightening program. Foreign central banks are reducing holdings. China has sold over $300 billion in treasuries in the past 3 years. Japan is selling to defend the yen. The BRICS nations are diversifying away from dollars. Domestic institutions are saturated. Banks are already holding record treasury positions, limiting their capacity to absorb more. In 2026, the Treasury must sell $9.2 trillion in refinancing plus $2.3 trillion in a new debt to cover the deficit. Total, $11.5 trillion in Treasury sales in a single year. There are not enough natural buyers for $11.5 trillion. Something will have to give. Either interest rates spike dramatically to attract buyers, which would accelerate the interest cost spiral, or the Federal Reserve reverses course and starts buying again, which would reignite inflation, or the Treasury fails to fully fund the government, which would trigger a constitutional crisis. There is no painless option. This is why the Treasury used code red language. They see the wall coming, they know the math doesn't work, and they are trying to warn anyone who will listen. Let me show you the evidence that confirms this crisis is real and approaching. Evidence 1, the Treasury's own projections. The same quarterly statement includes a chart showing interest expense as a percentage of GDP. The Treasury's baseline projection shows this ratio reaching 4.1% by 2026. The last time it was above 3.5% was 1991, immediately before a recession. They are projecting worse conditions than any in modern history. Evidence 2, Federal Reserve concerns. The Federal Reserve's most recent financial stability report devoted an entire section to fiscal sustainability risks. They noted that elevated and rising fiscal deficits pose a medium-term threat to financial stability. The Fed and Treasury don't coordinate their messaging. When both are warning about the same thing, the threat is real. Evidence 3, credit rating downgrades. In 2023, Fitch downgraded U.S. debt from OAA to AA+. Moody's placed the U.S. on negative watch. S&P had already downgraded in 2011. All 3 major rating agencies have either downgraded or are preparing to downgrade U.S. creditworthiness. Rating agencies are notoriously slow and conservative. When they move, conditions are already deteriorating. Evidence 4, bond market behavior. The yield curve has been inverted for the longest period in history. The 10-year Treasury yield has been extraordinarily volatile, swinging 50 basis points in single weeks. Bond markets are the smartest money in the world. Their behavior signals extreme uncertainty about fiscal sustainability. Evidence 5, foreign central bank actions. Central banks don't make public statements about their concerns. They express their views through action. Global central bank Treasury holdings have declined by $400 billion in 2 years. Simultaneously, central bank gold holdings have increased by the largest amount since the 1960s. They are quietly de-dollarizing while publicly saying nothing. Evidence 6. Congressional testimony. Treasury Secretary Janet Yellen testified before Congress last month that the debt trajectory was unsustainable and required significant policy changes. This is the Treasury Secretary saying the current path leads to crisis. 6 independent data points. The Treasury, the Fed, rating agencies, bond markets, foreign central banks, and the Treasury Secretary herself, all confirming the same conclusion. The fiscal trajectory is unsustainable. 2026 is the breaking point, and no one in a position of power is taking action to prevent it. Let me show you the mathematics that make this crisis inevitable without dramatic intervention. Start with the current baseline. National debt, $38.4 trillion annual deficit, $2.1 trillion average interest rate on debt, 3.2% annual interest expense, $1.2 trillion now project forward to 2026, new debt from deficits, $4.4 trillion in 2025, 2026, refinanced debt at higher rates, $9.2 trillion, new average interest rate, 4.8%, total debt by end of 2026, $42.8 trillion annual interest expense, $2.05 trillion. Now consider the death spiral mathematics. Higher interest expense adds to the deficit. The higher deficit requires more borrowing. More borrowing adds to the debt. Higher debt means higher interest expense. It's a feedback loop with no natural limit. Let me project this forward. By 2028, if current trends continue, total debt, $48 trillion interest expense, $2.6 trillion interest as percentage of revenue, 38%. By 2030, total debt, $55 trillion interest expense, $3.3 trillion interest as percentage of revenue, 45%. At 45%, nearly half of all federal revenue goes to interest payments. That is not a functioning government. That is a debt servicing operation with a government attached. Now consider the only mathematical solutions. Solution 1, raise taxes by 40% to close the deficit. Politically impossible, economically devastating. Solution 2, cut spending by 35% to close the deficit. Would require eliminating Social Security or Medicare entirely. Politically impossible. Solution 3, default on the debt. Would crash the global financial system. The dollar would lose reserve currency status overnight. Unthinkable. Solution 4, inflate the debt away. Print enough money to make the debt manageable in real terms. This is the only mathematically viable option. And it is devastating for savers, retirees, and anyone holding dollar-denominated assets. The Treasury knows these are the only options. That's why they used code red language. They are signaling that the endgame is approaching. The only question is which solution policymakers choose. History suggests they will choose inflation. Now let me explain what the Treasury is not telling you in their warning. They are not telling you that they already know the solution. The solution is inflation. Deliberate, sustained, policy-driven inflation that erodes the real value of the debt. If the government can generate 8% to 10% annual inflation while keeping interest rates below that level, the real value of the debt shrinks automatically. This is called financial repression. It was used after World War II to reduce debt to GDP from 120% to 30% over 2 decades. Savers were systematically robbed through negative real interest rates, while the government's debt burden evaporated. The same playbook is being prepared now. The Code Red warning is not a call for fiscal discipline. Congress has proven incapable of fiscal discipline for 50 years. The Code Red warning is a signal to insiders that the inflation solution is coming. Here's what that means for you. Cash loses value. Savings accounts lose value. Bonds lose value. Anything denominated in dollars loses value. Real assets gain value. Commodities gain value. Gold gains value. Silver gains value. Real estate gains value. Anything that cannot be printed gains value. The Treasury cannot tell you this directly. If they announced that deliberate inflation was coming, it would trigger a bond market crash, a currency crisis, and a political firestorm. So they use bureaucratic language like code red fiscal sustainability concerns. They let the smart money figure out what's coming, and they hope the general public doesn't understand until it's too late. The warning is hidden in plain sight. But you are reading it correctly. The message is, protect yourself from currency debasement. The timeline is, before 2026. The method is, convert paper assets to real assets. That's what the Code Red really means. If you have been warning about the debt, if you have been arguing that the fiscal path was unsustainable, if you have been accumulating hard assets while others trusted paper promises, this is your vindication. For years, the mainstream called you a doom and gloomer. They said the debt didn't matter. They said deficits were just numbers on a spreadsheet. They said modern monetary theory meant there were no constraints. The Treasury Department just admitted you were right. Code Red. The debt matters, the deficits matter, the constraints are real. The people who mocked fiscal concerns are now watching the Treasury confirm everything you warned about. You understood something fundamental that they refused to see. You understood that debt cannot grow forever. You understood that interest payments eventually consume everything. You understood that the only exit is currency debasement, and you prepared accordingly. The code red warning is not a surprise to you. It is confirmation. Hold your position. Add to your hard asset holdings. Continue protecting your purchasing power from the inflation that is coming. The Treasury just validated your thesis in official government documents. Your preparation was not paranoia. It was prescience. Let me give you a specific action plan for the next 18 months before the 2026 crisis materializes. Priority 1, reduce dollar exposure. Cash and savings accounts will lose purchasing power through inflation. The interest you earn will not keep pace with real inflation rates. Keep enough cash for 3 to 6 months of expenses. Convert excess savings to hard assets. Priority 2, accumulate precious metals. Gold and silver have protected purchasing power through every currency crisis in history. When governments inflate, metals appreciate. Physical metals in your possession have no counterparty risk. They cannot be frozen, devalued by policy, or inflated away. Target 10-15% of your portfolio in physical precious metals. Priority 3, own real assets. Real estate with fixed-rate mortgages benefits from inflation. Your payment stays fixed while your income rises with inflation. Commodities, farmland, and productive assets maintain value when paper currencies decline. Priority 4, reduce fixed income exposure. Bonds are promises to pay future dollars. If those dollars are worth less, your bonds are worth less in real terms. Long-term bonds are particularly vulnerable. Consider reducing duration or eliminating bond exposure entirely. Priority 5, prepare for volatility. The transition from debt accumulation to debt crisis will not be smooth. Markets will swing violently as policy responses are announced and evaluated. Position yourself to hold through volatility rather than being forced to sell at the worst time. Priority 6, stay informed. The next 18 months will bring increasingly desperate policy responses. QE may restart, yield curve control may be implemented, new currency frameworks may be proposed. Each policy shift creates both risks and opportunities. Follow the documents, not the headlines. The Treasury will continue publishing warnings for those who know how to read them. The 2026 crisis is not a prediction. It is a mathematical certainty based on current trajectory. The only uncertainty is the policy response. Position yourself to benefit from the most likely response, inflation. Let me leave you with this. The United States Treasury, the institution responsible for managing the finances of the most powerful nation on earth, has used emergency language to describe the fiscal trajectory. Code red. They have identified 2026 as the crisis year. They have acknowledged that interest expense is crossing into unsustainable territory. They have admitted in official documents that the current path cannot continue. This is not conspiracy theory. This is their own warning. $38.4 trillion in debt, $1.2 trillion in annual interest, $9.2 trillion in refinancing at higher rates. A 2026 timeline for crisis. The math is undeniable, the warning is clear. The only question is how you respond. You can ignore the warning and hope that politicians solve a problem they created and refuse to address. Or you can take the Treasury at their word and prepare for the currency debasement that is the only mathematical solution. The code red warning is not meant for the general public. It is meant for insiders who understand the language. Now you understand the language. The crisis is coming. The timeline is 2026. The solution is inflation. Prepare accordingly. This is Chronicles of Currency. The debt has hit $38.4 trillion. The Treasury has issued code red. Position yourself before the crisis arrives. I'll see you on the other side. If this analysis was valuable, subscribe and hit the notification bell. I'll be tracking Treasury statements and fiscal indicators as we approach 2026. Drop a comment. Do you believe the government will choose inflation? How are you preparing? Share this video with someone who needs to understand what the Treasury just admitted. The code red warning is real. The timeline is set. Chronicles of Currency, out.